The framing that carried most bond commentary through 2025, disinflation, patient easing, a glide back towards neutral, no longer describes the market. The US-Iran energy shock has reset the inflation impulse across the advanced economies, and the policy response has been a synchronized pivot to tightening bias. Now, if the macro says caution, then the micro screams abundance, and this is the tension that the market has not resolved. Global bond issuance has hit a record above 4 trillion by late July, driven simultaneously by AI-capex, a rebound in the merger and acquisition, and government deficits. The AI piece is where the concentration risk sits. The 5 hyperscalers sold roughly 159 billion of bonds through early June, a 47% jump on all of 2025, and Morgan Stanley sees hyperscaler issuance reaching about 400 billion for the year. This is more than double last year, and it is to help fund a capex program that could top $770 billion. Hello everyone, welcome back to our channel and welcome back to another episode of Capital Insight series. This series sits within our Fundamentals of the Noise series here at Punjab Capital Research, and today we wanted to take a macro and a micro view of the global bond market. What essentially is happening in the global bond market is that there is a tightening macro situation happening and an AI supply flood. There are 3 shocks that are hitting the bond market at once: a reinflation regime that has turned every major central bank hawkish, an AI-capex issuance wave concentrated in a handful of names, and a fiscal repricing at the long end. However, the credit is being priced as if none of them exists. Let's start with the regime change, the regime that has flipped. The framing that carried most bond commentary through 2025, disinflation, patient easing, a glide back towards neutral, no longer describes the market. The US-Iran energy shock has reset the inflation impulse across the advanced economies, and the policy response has been a synchronized pivot to tightening bias. The clearest marker is at the Federal Reserve, now run by Kevin Warsh since May. At the 29 July meeting, the FOMC held at 3.50 to 3.75% on a 9-3 vote. However, the 3 dissents were the more notable part because these are the most dissents in a single direction since 2016. And the committee's own projections now pencil a hike by the year end. This is not an easing cycle paused, it is a hiking cycle being actively debated. The European Central Bank has gone further still. It is now the only major central bank actively raising rates. It cut early in 2026, reversed after the war began, and on 11th of June delivered the first hike since 2023, lifting the deposit rate to 2.25%. It held there on July 23rd, but the markets have all priced a September move to 2.50%. The ECB is drawing this into a textbook stagflation box, inflation at 2.8% against a growth of roughly 0.8%. The hardest environment a central bank can face because the tool that fights inflation is the same that deepens the drawdown. The Bank of Japan completes the picture. It hiked to 1% in June, the highest policy rate since 1995. Held in July and continues to taper its JGB purchases while warning that underlying inflation could run above 2%. The yen remains weak at 159 to 162 range, and the market is alert to the tail risk that Japan's Ministry of Finance sells reserves to defend it, a move that would land directly at the long end of the treasury curve. The common spine here is the energy shock feeding a global reinflation pulse, and it shows up most violently in the long end. Term premium, widening fiscal deficits, and rising yields everywhere are pushing 30-year paper to multi-decade highs at the same time. Crucially, curves are steepening rather than inverting. The front end is anchored by policy that won't ease, and the long end is repricing for supply and risk. So essentially, the macro read is that the duration is no longer a one-way bet. With 3 central banks biased to hold or hike and the long end absorbing fiscal and geopolitical supply, the risk-free curve is steepening from both the ends. The front end offers real carry, the long end is where the repricing risk lives. Let's now talk about the supply and credit paradox. Now, if the macro says caution, then the micro screams abundance, and this is the tension that the market has not resolved. Global bond issuance has hit a record above 4 trillion by late July, driven simultaneously by AI-capex, a rebound in the merger and acquisition, and government deficits. The AI piece is where the concentration risk sits. The 5 hyperscalers sold roughly 159 billion of bonds through early June, A 47% jump on all of 2025, and Morgan Stanley sees hyperscaler issuance reaching about $400 billion for the year. This is more than double last year, and it is to help fund a capex program that could top $770 billion. Technology now accounts for roughly 18% of the total US corporate issuance and a record 10.3% of investment grade market, with issuers reaching for ultra-long maturities, including a rare 100-year sterling bond from Alphabet. Now, here is the paradox what the whole piece. Despite that flood credit is priced for perfection, high-yield spreads sit at nearly 275 to 280 basis points, the richest decile in their history against long-run medium close to 450 basis points. Investment grade trades at nearly 80 basis points, and the triple B is near 100 basis points, both close to 25-year tights. The HY to IG ratio is roughly 3.5x, in line with its long-run average, which tells you that the tightness is market-wide and not a distortion in one rating tier. All-in yields are also genuinely attractive. Now, this is a carry regime, and carry regimes can persist for quarters, but they can also unwind quickly. The one place that the market is telling the truth is inside the AI trade. Google, Amazon, and Meta all have seen spreads widen as investors demand more to lend, and Oracle's 5-year CDS, the go-to proxy for the AI debt fear, sits at multi-year high. Deals still clear at 4 times oversubscribed, but at wider new issuance clearance than the broader market. So the market is still discriminating within the cohort while pricing everything around the cycle tightens. That selective anxiety is the signal, the blanket calm is the complacency. And the plumbing response of the market is that the dim sum, panda, and kangaroo issuance records are the markets routing around a congested USD-Euro hold. Two forces overlap: cyclical crowding, that is hyperscalers absorbing core market capacity, and structural reserve fragmentation, genuine Asian and diversifying demand. Also, Portugal swapping dim sum proceeds back to euros at the saving is a tale. Diversification has crossed from vanity trade to treasury-desk default. Now read all these signals together: the funding side internationalization of renminbi, the reach for 40 to 100-year maturities, and the flight to Australian and offshore-yuan markets are all the same story. Capital finding the path of least resistance when the traditional core is both expensive in duration terms and crowded with mega supply. It is happening through the funding side, not through the reserve side, which is exactly why it is undercovered. And for the allocators, the concrete near-term catalyst is September's post-summer issuance calendar, the heaviest of the year, testing the market's appetite at minimal concessions. An oil reversal energy is actually at 10% of the HY index, or one disappointing AI-capex payoff headline is all that it takes to move the marginal clearing price. And at these spreads, there is really no cushion. Now, that's all that we wanted to share with you in this update on the global bond markets, the macro and the micro of it. Hope you've enjoyed the episode. Stay tuned in for our next one.